Welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and today is March 10th, 2025. It's a bright and brisk morning out there in the world of finance, and I'm excited to take you through today's market narrative. So grab your coffee, sit back, and let's dive right in.
Let's start with a quick market overview. Our major U.S. indexes have given us plenty to talk about today. The S&P 500 is sitting at around 5,670.31, down by roughly 0.61%. Over at the Dow Jones, we see a reading of about 42,501.8, with just a whisper of a decline, nearly 0.01%, practically a day at the park for that index. And then there's the Nasdaq, currently trading around 17,672.7, softening by about 0.9%. Rounding out our index rundown is the Russell 2000, which is at roughly 2,042.23, down by around 0.77%.
Turning to the cryptocurrency realm, Bitcoin is trading at nearly 79,874.75, reflecting a decline of about 1.1%. Ethereum, on the other hand, shows a modest lift at roughly 2,021.276, up slightly by 0.146%. These numbers remind us that even in the cryptocurrency market, which some affectionately call the Wild West, even the most adventurous assets take their hits on a rainy day.
Now let's move on to a deeper exploration of major market trends that are capturing the attention of investors across the board. It seems like we're seeing a season of cautious recalibration. Traditionally, when indexes slide by small but noticeable margins like we've just seen, it's a cue for market participants to dive a little deeper into what underlying forces might be influencing them. For instance, the slight softness in our indexes today is occurring against a backdrop of several economic headwinds as well as sector-specific shifts.
One prevalent trend we're noticing is that investors are increasingly eyeing growth stocks, especially those that will suffer early losses this year. There's a spotlight on a set of 13 growth stocks that have dropped significantly year to date. Analysts, however, remain optimistic about a reversal. They're saying these companies could start paving their way back up, expecting revenues to climb at least double the pace of the S&P 500, and envisaging stock gains of no less than 29% over the next 12 months. Now, if that doesn't spark a bit of hope amongst those who enjoy a comeback story, I don't know what will.
What's particularly interesting about this story is the resilience inherent in these companies. When growth stocks feel the pressure, it's often because the market is overstretched at one point. But take a moment and think about it. Historical trends tell us that after periods of heavy selling and dip buying, a robust rally sometimes follows. It's a bit like that old car in the movie, battered and bruised, but with a heart that just won't quit. And for astute investors, these scenarios often lead to some of the most rewarding opportunities.
Speaking of buying the dip, another headline making waves is all about one hard-hit tech stock that's caught the fancy of some bold market players. A familiar refrain among these investors is, "We're buying the dip." Essentially, despite a sharply lower open on Monday, some savvy folks are stepping in with a single, decisive buy order. It seems they believe that current prices offer a window of opportunity that could be hard to come by again soon. This move mirrors a broader market sentiment where, despite a day or two of loss, the long-term view still shines brightly. And let's be honest, sometimes a little risk-taking is exactly what spices up the trading day. After all, if our portfolios didn't give us a little adrenaline rush every now and then, would investing really feel like an adventure?
Shifting gears yet again, another recurrent theme that has been making the rounds in our market narrative is the idea of a multifaceted safety net in the form of various puts that seem to be propping up the market. Yes, you heard that right. We're talking not just about the well-known Fed put or even the Trump put, but also something that some are now calling the C-suite put. City strategists have been highlighting a fascinating trend where companies, in an effort to reinforce their stock prices, are switching gears from capital expenditure towards buybacks. This means that instead of funneling capital into growth initiatives, companies are putting their money into repurchasing their own shares, essentially setting a floor under the stock prices. It's a nuanced approach that reminds us how creative corporate strategies can be in times of market stress.
While this might sound like just another story from a corporate board meeting, it reflects a deeper trend. Companies are actively taking steps to buffer their valuations against external shocks.
And of course, no market discussion would be complete without looking at what's happening in the tech space. One story that's really sparking conversations is about NVIDIA. The company's stock, which by certain metrics appears to be undervalued, might soon benefit from the excitement surrounding its upcoming annual conference. Investors and analysts are keenly anticipating next week's GTC event as a potential catalyst for what could be a significant run-up in the stock's price. This is particularly significant in an environment where sentiments towards AI stocks have at times turned somewhat sour. Nvidia, often seen as the crown jewel in the tech sector, might just offer a counterpoint to that sentiment. It's an exciting time to be following the tech sector, especially when every announcement seems to have the potential to send ripples through the entire market.
Now, let's tie these individual stories together with a detailed sector analysis touching on technology, energy, finance, and a few other sectors that are feeling the heat or the lift in the current market climate. Starting with the technology sector, we can't ignore that the tech world is often the trendsetter for market optimism. Today's narrative is filled with contrasting themes. On one hand, tech stocks have been hit hard earlier in the week, leading some investors to say, "We're buying the dip." On the other hand, industry giants like Nvidia are emerging as potential rally candidates. This dichotomy suggests that while short-term volatility may persist in tech, the long-term outlook remains bullish for companies that can show tangible growth and innovation. I sometimes joke that tech investors are like surfers. They might wipe out sometimes, but when they catch the right wave, it's a spectacular sight to behold.
Switching to the energy sector, while there isn't a headline today specifically highlighting energy companies, the implied market sentiment is that investors are becoming more risk-averse and continuously looking for stability. Historically, when traditional sectors like energy aren't front and center, it can suggest that broader market uncertainty is nudging people away from cyclical stocks and towards areas that promise steadier returns. And that's where finance comes in. Financial stocks tend to benefit from the kind of corporate maneuvers we mentioned earlier, such as buybacks. Companies in the financial sector are also paying close attention to global macroeconomic trends, from interest rate expectations to evolving monetary policies. It's a sector that might not always headline the news, but it quietly underpins much of the market structure.
And if you ever feel like the financial world is a bit too buttoned up, just remember that their boardroom strategies can sometimes lead to the kind of market moves that rival even the more audacious tech plays.
Speaking of global market implications, it's important to recognize that these national trends rarely occur in isolation. Global markets are intricately connected, and the investor sentiment we see here often permeates across continents. When U.S. indexes like the S&P 500 dip even slightly, it can influence market openings in Europe and Asia. And with the ever-present unpredictability of geopolitical events, investors are being more cautious than ever. The commitment to buying dips or switching to buybacks may signal that investors are hedging against broader global uncertainties. Whether it's concerns about inflationary pressures, trade disputes, or regulatory changes, the global stage is set with a few formidable challenges and even more opportunities.
Now let's bring in some expert insights and predictions to round this discussion out. One perspective I find particularly compelling is the notion that markets, though they may falter from time to time, have a naturally cyclical rhythm. Today's market softness, the slight declines in major indexes and in Bitcoin, could very well be the preamble to a longer-term recovery. Analysts who champion the potential of growth stocks believe that the current drop is merely an opportunity waiting to be seized. In fact, some experts even go so far as to suggest that if you're buying the dip today, you might very well be sitting on a prelude to the next big rally. And who can argue with the wisdom of history? Every major market rally has been built on moments when investors chose to step in rather than step back.
On the flip side, critics warn that the market's current volatility might be a harbinger of more turbulent times ahead, especially if economic indicators start suggesting slowing growth or rising inflation. The mosaic of opinions among seasoned analysts is what makes the investment world so fascinating. It's as if everyone has a piece of the puzzle, and only together can we get a full picture of where things are headed. In times like these, it's crucial to remain nimble, well-informed, and prepared to pivot as new data emerges.
Let's pivot now to a comprehensive coverage of some 10 to 12 important stories that are lighting up our headlines today. First off, the recurring narrative around those 13 growth stocks is hard to ignore. These stocks have taken a beating this year, which many might see as a setback, yet analysts maintain a bullish stance by projecting revenue growth at least double that of the S&P 500. This transformation narrative is compelling, especially in an era where growth isn't just about top-line numbers, but also about sustainable long-term evolution.
Next, we have the repeated stories about buying the dip in a major tech stock that experienced a sharply lower open on Monday. The fact that multiple outlets are covering this maneuver speaks volumes about the confidence certain investors have in the company's fundamentals. It's almost as if you can hear the internal dialogue of these investors. We get it, the market's been rough, but we see something here that just can't be ignored. It's a classic example of taking a calculated risk during market turbulence.
In a similar vein, the narrative around the so-called Fed, Trump, and C-suite puts is crucial for understanding current market dynamics. Here, we're seeing a convergence of monetary policy influence, political sentiment, and corporate governance strategies. The emphasis here is that companies are actively using share buybacks as a sort of soft landing for their stock prices. This strategy, according to Citi's experts, is particularly significant given an environment where traditional capital expenditures may not yield immediate returns. Essentially, this is a sign of a more mature, self-assured market where businesses are taking charge of their own fates by supporting their share price from within.
Moving forward, we have fresh buzz around NVIDIA. The tech giant stock is considered cheap by certain metrics, and with their annual conference, the much-anticipated GTC, on the horizon, investors are buzzing with anticipation. It's like waiting for your favorite band to drop a new album. The excitement is palpable, and the potential for a breakthrough is high. NVIDIA's upcoming conference will undoubtedly be a litmus test for investor sentiment towards artificial intelligence and related technologies.
Then we have the broader discussion about market trends, where tech remains at the forefront. Stories pointing to these undervalued growth stocks, which might well experience a remarkable turnaround, challenge the narrative that a market dip is a sign of doom. Instead, the message is one of cautious optimism. Sometimes the market's nadir is simply the preface to a resurgence.
Additionally, there's been plenty of chatter around corporate strategy and governance, particularly the role of share buybacks in today's corporate ecosystem. This move, shifting from aggressive capital expenditures to more measured buybacks, sends a clear signal that companies are prioritizing shareholder value. It's an intriguing strategy that has implications for market liquidity and corporate confidence alike.
And don't forget the global narrative. While much of our focus is on U.S. markets, the ripple effects are being felt around the world. Emerging markets, in particular, are finding themselves at the crossroads of domestic growth and the echoes of global headwinds. With every market move, the interplay between local economies and global trends becomes clearer. Investors are keeping an eagle eye on these correlations, weighing the risks and potential rewards.
Another noteworthy story is about the acceleration within the tech sector, which continues to fuel market speculation. Despite some investor unease, the rapid evolution in tech innovations drives home a fundamental truth: disruption is both inevitable and essential. The challenges that tech companies face today may well be the catalysts for the transformative breakthroughs of tomorrow.
Rounding out our list is a closer look at investor behavior itself. Experts are noting that the market mentality seems to oscillate between fear and opportunity. While some are quick to sell at the sign of downturns, others, with a long-term vision, choose to buy. This dynamic creates an environment that is both reactive and opportunistic, an environment where every downturn may well mask the promise of an uptick. It's like a roller coaster ride that, despite its drops and turns, ultimately leads to breathtaking highs if you hang on tight.
Now let's take a moment to focus on detailed sector analysis, starting with technology. As I mentioned, technology has always been the bellwether for market sentiment. Today's narrative points to a tension between short-term volatility and long-term growth prospects. Take NVIDIA, for example. Despite some investors getting jittery over the general market softness, the company's fundamentals remain robust. Its upcoming GTC conference is not just a corporate event, it's a rallying point for tech enthusiasts and investors alike, who see the potential for AI-driven innovations as the next frontier of market growth. It's a reminder that behind every headline about a drop in tech stocks, there's usually a deeper, more promising story about innovation and resilience.
In the energy sector, while the headlines might be sparse today, the underlying themes are instructive. Energy companies have long been the barometer for broader economic confidence. When investors feel uncertain, energy stocks often become a kind of safe haven, though not without their own risks. Global supply constraints, policy shifts, and environmental concerns all contribute to a dynamic that is as complex as it is critical. And here's where I like to inject a little humor. Energy stocks might not be as glamorous as tech startups, but they're as essential as your morning cup of coffee, even if you're not always excited about the price at the pump.
Finance, on the other hand, is currently getting a lot of love thanks to the strategic moves we discussed earlier, like the shift from capital expenditures to buybacks. In today's regulatory and economic environment, financial institutions are repositioning themselves to not just weather the storm, but to capture the opportunities that volatility creates. It's a sector that embodies both caution and aggression, which is why watching their next few moves is like binge-watching a suspense thriller. Every new development leaves you at the edge of your seat.
Now let's not forget about global market implications. While our domestic indexes and stories dominate the conversation, the pulse of the global market is equally important. When U.S. markets fluctuate, there's an almost immediate domino effect that influences European, Asian, and emerging markets. Investors worldwide are paying close attention to trends like share buybacks and growth stock rebounds because these dynamics often signal shifts in capital flows. Moreover, global policy decisions, be it interest rate adjustments or trade negotiations, can amplify these effects, making it all the more crucial for us to stay informed. It's a reminder that in today's interconnected world, a shift in sentiment in one part of the globe can reverberate across continents.
Bringing in some expert insights, I've been chatting with several market strategists recently who've reinforced the idea that volatility is not inherently negative. One analyst championed the view that the market's recent dips are setting the stage for an environment where buying the dip is not just a catchphrase but a proven strategy. The interplay between corporate actions like share buybacks and the cautious optimism around growth stocks underscores a broader market resilience. Essentially, we might be witnessing a temporary correction that could pave the way for a robust rebound.
Others are more circumspect, noting that while there's promise in these developments, caution is warranted. After all, relying too heavily on one sector or strategy can expose portfolios to unforeseen risks. It's a bit like putting all your eggs in one basket. If that basket happens to drop, you're going to end up with a scrambled mess. So diversification and a careful eye on global economic indicators remain as critical as ever.
Before we conclude, I want to throw a few thought-provoking questions your way. Have you ever considered how the strategic shift to share buybacks might reshape the landscape of corporate governance? Could the anticipated rally in undervalued tech stocks like Nvidia's be the tipping point for broader market recovery? And on a more personal note, what's your approach when the market sends mixed signals? Do you choose caution, or do you dare to dip in and ride the wave? These are the kinds of questions that keep our discussions vibrant and our decisions well-informed.
As we draw today's briefing to a close, let's highlight some key takeaways. We've seen that the major indexes from the S&P 500 to the Nasdaq and Russell 2000 are experiencing modest declines, reflecting a cautious market mood. Cryptocurrencies like Bitcoin have dipped notably, while Ethereum has shown a slight uptick, reminding us that even in the most volatile domains, there are always contrasting signals. The narrative around those 13 growth stocks, with their potential double-digit revenue growth and an expected 29% stock rise over the next 12 months, is certainly one to watch. And in the tech sector, from bold dip-buying strategies to the anticipatory excitement around Nvidia's upcoming conference, the opportunity lies in both resilience and innovation.
Our journey today covered a wide array of sectors, each with its own set of opportunities and challenges, and we even touched on the global implications of domestic market moves. Throughout our conversation, we've seen that the cautious optimism permeating both corporate strategies and investor sentiment might just be the pathway to the next significant rally. It's a complex, fascinating landscape where every dip can signal a deeper strength, and every cautious step by an investor might just be the prelude to an impressive leap forward.
Before I sign off, let me give a special shout out to Pantheon AI, your information co-pilot. Our mission is to ensure that you're not only up to date with market happenings, but also equipped to make informed decisions in an ever-evolving landscape. As always, I encourage you to think about the strategies we discussed today. Reflect on your own portfolio and consider whether now might be the right time to act on some of these insights. Are you ready to buy the dip? And how do you watch the interplay between corporate buybacks and market performance shaping your long-term financial strategy?
In closing, I want to leave you with a final thought. Learning shouldn't feel like a full-time job. Whether you're a seasoned trader, a cautious investor, or someone who simply loves to watch the market's pulse, remember that every challenge brings with it a wave of opportunity, if only we're willing to keep our eyes open and our minds sharp.
Thank you for joining me on this journey through today's market nuances. I appreciate your time and attention, and I look forward to picking up our conversation tomorrow. Until then, keep asking questions, keep exploring, and always know that you can turn to our AI co-pilot for any inquiries. Have a wonderful day and stay invested in your future.